Welcome back to Oil and Gas Futures 101. In episodes 1 and 2, we covered what futures are and how to place your first trade. Now comes the big question: what actually makes oil prices move? If you're going to trade crude, you need to understand the forces driving it. In this episode, we'll break down the 5 biggest factors: OPEC, inventory reports, the dollar, geopolitics, and seasonality. Let's get into it. The single most powerful force in oil markets is OPEC. That stands for the Organization of Petroleum Exporting Countries. It's a cartel, a group of oil-producing nations that coordinate how much oil they pump. The current group is called OPEC+, which includes the original members like Saudi Arabia, Iran, and Venezuela, plus allies like Russia. Together, they control about 40% of global oil production. Here's why they matter. When OPEC decides to cut production, supply goes down and prices go up. When they increase production, supply goes up and prices drop. These decisions happen at regular OPEC meetings, usually every few months. But surprise announcements can happen anytime. A single headline like, Saudi Arabia announces 1 million barrel per day cut, can move oil 5 to 10% in hours. On the other side, you have US shale producers. The United States, Canada, Guyana, and Brazil have been adding about 1 million barrels per day of new production each year. This non-OPEC supply growth is a constant bearish pressure that OPEC has to work against. The key thing to watch: OPEC meetings and any surprise production announcements. These are the single biggest catalysts for oil price moves. Every Wednesday at 10:30 a.m. Eastern Time, the Energy Information Administration, the EIA, releases its weekly petroleum status report. This is the most important recurring data point for oil traders. The report tells you how much crude oil is sitting in storage across the United States. Think of it as a supply check. If inventories draw, meaning there's less oil in storage than last week, that's bullish. It means demand is outpacing supply. Prices tend to go up. If inventories build, meaning more oil was added to storage, that's bearish. Supply is exceeding demand. Prices tend to drop. But here's the key: it's not the actual number that moves markets, it's the surprise. Every week, analysts publish a consensus estimate, their best guess of what the number will be. If the actual number is significantly different from that estimate, prices react. For example, if analysts expect a 2 million barrel build, and the actual report shows a 5 million barrel draw, that's a massive bullish surprise. Oil could spike 1 to 3% in minutes. There's also a preview report from the API, the American Petroleum Institute, released every Tuesday evening at 4:30 p.m. Eastern. It's industry compiled and often hints at what the official EIA number will be. Pro tip: volatility spikes dramatically at 10:30 a.m. on Wednesdays. Threads widen. Slippage is common. Many experienced traders wait 5 to 15 minutes after the report before entering a trade. Oil is priced in US dollars everywhere in the world. This creates an inverse relationship. When the dollar gets stronger, oil tends to get cheaper, and vice versa. Why? Because a stronger dollar means foreign buyers need more of their own currency to buy the same barrel of oil. That reduces demand. A weaker dollar makes oil cheaper for foreign buyers, which increases demand. You can track dollar strength using the dollar index, also called the DXY. When DXY goes up, expect downward pressure on oil. When DXY goes down, expect support for oil prices. Interest rates play into this too. When the Federal Reserve raises rates, it strengthens the dollar, bearish for oil. It also slows economic growth, which reduces energy demand. Double bearish. The VIX index, that's VIX, measures stock market fear. When the VIX spikes, it usually means risk off across all markets, including oil. Extreme VIX readings above 30 often correlate with sharp oil sell-offs. Finally, watch GDP growth, especially in China. China is the world's largest crude oil importer. Any slowdown in Chinese economic activity directly impacts global oil demand. When China's economy is booming, oil demand rises. When it stumbles, oil demand falls. The macro picture sets the backdrop. OPEC and inventory reports create the short-term moves, but the dollar and growth trends determine the longer-term direction. Oil is a geopolitical commodity. Unlike stocks or bonds, the supply of oil can be physically disrupted by wars, sanctions, and conflicts. The most critical choke point in the world is the Strait of Hormuz, a narrow waterway between Iran and Oman. Nearly 20% of the world's oil supply passes through it every day. Any threat to close or disrupt this strait, whether from Iranian tensions, military conflict, or piracy, can spike oil prices almost instantly. In 2025, tensions in the Middle East caused Brent crude to jump from $71 to $94 per barrel in under 2 weeks. That's a 32% move driven entirely by geopolitical risk. Sanctions are another major factor. When the US or Europe imposes sanctions on oil-producing countries like Russia, Iran, or Venezuela, it removes supply from the global market. Less supply at the same demand means higher prices. Pipeline disruptions, refinery outages, and hurricanes in the Gulf of Mexico can also temporarily spike prices. Hurricane season, June through November, is a recurring risk factor for US Gulf Coast production. The key takeaway with geopolitics: these events are unpredictable and can cause massive, sudden price swings. This is why you always use a stop loss. A geopolitical headline at 2 a.m. can gap oil 5% before you wake up. Oil prices follow seasonal patterns driven by predictable demand cycles. These aren't guarantees, but they're tendencies that have played out historically. Spring, March through May, tends to be bullish. Refineries ramp up production to prepare for the summer driving season. Gasoline demand rises, and crude oil gets consumed faster. Summer, June through August, is mixed to bullish. It's peak driving season in the US and Europe. Gasoline demand is at its highest, supporting oil prices. Late summer into fall, August through October, is often when prices peak and begin to roll over. Refineries go into maintenance mode. Product inventories are usually well stocked by this point. Late fall and winter, November through January, tends to be weaker. Demand drops after driving season ends. Weather-dependent factors like heating oil demand can create volatility, but overall this is historically the weakest period. Now, a huge caveat: these seasonal tendencies can be completely overwhelmed by a single OPEC decision, a geopolitical event, or a major economic shift. Monthly standard deviations in oil range from 7 to 14%. So don't trade on seasonality alone. Use it as a secondary factor that confirms or contradicts your primary analysis. Let's recap the 5 forces that move oil prices. 1. OPEC controls supply. Production cuts are bullish. Production increases are bearish. Watch OPEC meetings closely. 2. EIA Inventory Reports every Wednesday at 10:30 a.m. Eastern. It's not the number that matters, it's the surprise versus the consensus estimate. 3. Dollar strength and oil have an inverse relationship. A stronger dollar is bearish for oil. Also watch interest rates, the VIX, and Chinese economic data. 4. Geopolitics can cause sudden, unpredictable price spikes. The Strait of Hormuz, sanctions, and supply disruptions are the big risks. Always use a stop loss. 5. Seasonality creates soft tendencies. Spring is bullish, fall is bearish, but these can be overwhelmed by bigger forces. In episode 4, we'll cover money management, the 1 to 2% rule, position sizing, and how to avoid blowing up your account. This is the episode that separates gamblers from traders. See you there.